Uranium Energy Corp, one of only 12 uranium producers in the world. UEC trades on the New York Stock Exchange. They have more than doubled their in-ground uranium resource over the past 2 years. They've also become one of only 6 uranium producers in the United States. Led by Amir Adnani, who has been ranked as one of the top resource CEOs by Casey Research, Amir has attracted major investors like Rick Rule of Sprott Asset Management, Li Ka-shing, the richest man in Asia, and institutions such as Vanguard and BlackRock. Learn more about Uranium Energy Corp at uraniumenergy.com or by calling 866-748-1030. Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with legendary investor Rick Rule with Sprott Asset Management. He is the man who's made a lot of investors money in the natural resource market, and he also has a great reputation. The more you learn about the natural resource sector, you'll find that there's a lot of people who have made money, but not a lot of people with a great reputation, and Rick has both, and they are both right at the top tier. Rick, thank you so much for joining us.
Flattery will get you everywhere. Thank you for having me.
Well, hey, Rick, I got some great questions for you, hopefully today, for my subscribers. Copper's falling, oil's falling, demand isn't rising, but the TSX, I mean, we look at it, and I mean, it's so low when you look at a multi-decade chart. And I wanted to ask you, what is the courageous and smart thing to do right now? Should we be sitting on cash because there really just isn't growth driving the U.S. economy, really? Or should we be buying these juniors because of that multi-decade low we're seeing in the TSX venture?
Well, I have substantial cash, and it isn't really a strategic decision. It's really governed by virtue of the fact that while the industry is in desperate need of capital, the issuers are not willing to issue capital by way of private placements in terms that are willing to induce me into the market. Certainly, investors should always have cash. Cash gives you the means and the courage to take advantage of market dislocations and, frankly, to take advantage of the mistakes of others. I have to say I'm overweight cash right now because I expect a floodgate to open with regards to the availability of financings on reasonable terms. But of course, the last time you interviewed me, I expected the same thing, and thus far, I've been wrong.
Well, that leads me to ask. I mean, you've been in so many more of these cycles than anyone else has. Obviously, especially people who are just getting involved in this because they're worried about the economy. They want to own some hard assets. So, is the TSX venture? When you look at that chart, doesn't it look safe? I mean, like you said, it's down 80%.
The TSX venture, to people who don't study, will never be safe because people need to understand that the index in aggregate is valueless. 80% of the companies on the index have no reason to exist, and ultimately will go to their intrinsic value, which is zero. All of the value of the index is in the best 20% of the issuers. It would behoove your investors both to spend time understanding the implication of the low prices in the index, which is, of course, very positive, but more importantly, to understand how to differentiate between the good, the bad, and the ugly, to use movie parlance. The good are truly good, and what's better about them is that the amount that they've fallen by is indicative of the market as a whole. You know, further to your point, Dan, a market that's down 83% in nominal terms and 90% in real terms is arithmetically 83% more attractive and 83% less risky.
Rick, I'm excited because I've been following this sector for 3 or 4 years now, maybe 4 or 5 years now, and it seems like it is a great opportunity to get in. But now here's like this total curveball in the last 6 months here. Now oil's down, and I gotta say, I sit there and look at my portfolio and look at the cash that I want to allocate, and I want to know what your thoughts are on the relative attractiveness of the oil stocks being down now versus the mining stocks, which have been down. But the oil stocks, to me, as someone who is a novice compared to you, the oil stocks are so much easier to love and they're much easier to understand. And I can totally see them doubling, oil price doubling, on just one event that would be headlines on CNN. But the mining stocks seem like they, it doesn't matter. You can print money, you can have grease, and nothing's going on with the gold price. So I guess to clean up my question there, with oil down, does it now put you in a predicament where, hey, why buy mining stocks when I can just focus on oil stocks now?
Dan, that's a $2 trillion question, of course, but I think you're early on the oil stocks. I think you're early for a couple of reasons. The first is that the oil industry was enormously overcapitalized. 8 years of high oil prices, 8 years low cost of capital, 8 years of being investment darlings caused them to be enormously overcapitalized. And the consequence of that is that despite low commodity prices, they will continue to produce, even at unprofitable levels, down to the cash cost of extraction. In other words, they will cannibalize their capital. And this can go on for 2 or 3 or 4 years. We've seen that in other markets in the past. The second reason that you have to be cautious is that you need at least 2 quarters of operating statements, income statements and financial statements, to see how the companies adjust to these lower prices. The third reason is that you will want to see how the third-party engineered reserve reports that these companies publish with their year-end financial statements will look relative to prior years. The net present value of future cash flows is one number at $90 and a very different number at $55. Those numbers will come out in May or June, and you will want to see those numbers before you wade back into the oil market. And finally, there is an enormous gap between the pricing assumptions 2 and 3 years out used by the engineering firms and the prices that are estimated by the futures markets 2 or 3 years out. Those numbers need to reconcile before those numbers can be added to the net present value calculations. And those third-party net present value calculations will be used to calculate the borrowing bases of the public oil and gas companies in the United States and Canada. Some of those companies will not be able to borrow any money at all and will, in fact, have to sell properties to reduce their debt, and they'll be selling properties into a market that is constrained, cash constrained. So I wouldn't be coming into companies below the very large integrated oil and gas company level until the third or fourth quarter of 2015, until those questions are answered.
Mm-hmm. So when you talk about Chevrons, BPs, I mean, you can buy these stocks with yield right now, and is that what you're saying? You're with outside of them?
I'm saying if you want to come back into the sector, come into the very largest integrated companies that can absorb the shock of lower oil prices with higher refining and marketing margins. The part of the market that most of your readers and listeners are interested in is substantially smaller market caps.
Yeah.
And it's too early to tell how much damage is going to be done by these prices. It's going to take at least till the third or fourth quarter this year.
Are you seeing anything as far as like when it comes to Texas and North Dakota? Are there a lot of layoffs going on, or are there a lot of expected layoffs if oil stays around this $50 level?
Oh yeah, the service companies that have been so busy drilling the multi-leg horizontal pads are slowing down pretty dramatically. The big service companies have already started laying off people, and you're going to see pretty dramatic reductions in capital budgets. So certainly the overheated nature of the service and supply sector and the overheated nature of the employment markets in West Texas, South Texas, and in North Dakota will slow substantially.
Rick, it's a bit frustrating that the Keynesians, they said there wasn't going to be inflation from printing. And, we could definitely point to food and single-family homes or the Dow Industrials, but the problem that frustrates a lot of people, especially my listeners, is that we, and including myself, subscribe to the Austrian theory, where you would not just expect food to go up or stocks, but you would expect specifically one asset, the yellow metal, gold. And gold has not fared well at all in this inflationary environment. It's a no-growth inflationary environment, but the fact is the food prices are up. You go to buy a book prices are up. The Dow's at an all-time high. Single-family homes are soaring. Why has gold just kind of fallen apart here as an inflation hedge over the past 3.5 years?
If you Google that question, you'll find 60 answers to it, and I think 59 of them are insignificant. Gold is in a war with the U.S. dollar. The U.S. dollar is the hegemonistic medium of exchange in the world, and there's confidence surrounding both the U.S. dollar and the U.S. economy. I don't believe that gold will win the war, and I don't think it needs to. I think that gold needs to lose the war less badly, and I think it will do that. I think it's important to note that gold has performed very well in almost every currency in the world with the exception of the U.S. dollar, reminding me eerily, frankly, of 1999, 2000, and 2001. You'll recall that late 2001, early 2002, gold began to move up in U.S. dollar terms as well, and that was the beginning of a rampaging bull market. Mm-hmm. I'm not suggesting that the fact that gold seems to be doing well now in U.S. dollar terms, too, heralds the new rise of gold. Simply to say that gold has performed for people around the world, with the exception of people in the United States or people whose savings or investments are domiciled in U.S. dollars. Now, with regards to the U.S. dollar, I think it's important to note that the primary savings instrument in the world is the U.S. 10-year Treasury. It's the one that all other yield instruments, and in fact other investments, are geared off of. And I think the major part of the attractiveness of gold to me is based on that fact. The U.S. 10-year Treasury has about a 1.6% yield. 1.6% yield against a CPI rate of inflation of 1.5 or 1.6% is singularly unattractive. Jim Grant calls it return-free risk. In fact, there's $4 trillion in sovereign securities worldwide that have negative real returns. In other words, they guarantee that they are going to cost you money. That means, going forward, that the holding costs associated with holding gold are very low, practically nil. It also means that the attractiveness of other assets to gold is similarly low. As to timing, it's important to understand that just because something has to happen doesn't mean it has to happen immediately. One of the most consistent mistakes of my career has been that I confuse the words imminent with inevitable. And I believe that gold's ascendancy in U.S. dollars is inevitable, but it may not be imminent. It's important to remember that this is not unique in financial history. I would point to George Soros, who said that he became a billionaire by finding broadly held public precepts that were demonstrably wrong and betting against them. Now, he was on the wrong side of the British pound trade for almost 2 years. Cost him a lot of margin carry, cost him a lot of reputation. But when he was right in 10 figures. Similarly, John Paulson began his bet against the structure of the U.S. mortgage economy in 2005. He was wrong in 2005, and he was wrong in 2006, and he was wrong in 2007, and he was wrong for part of 2008. But when he was right to the tune of $20 billion. What do you think will happen to people who are complacently long $4 trillion in sovereign debt that guarantees to lose them money? What do you think happens to them if interest rates rise? My own personal point of view, well, I'm not abandoning all other investments and going slavishly 100% in gold. I certainly feel better about the precious metal that I have for some time, in large measure because this dichotomy between what it should do and what it has done has been going on for so long, and because the price relative to the price of competing assets is so low.
Looking for anomalies. I've got to plead ignorance on this. I don't know my history as well as you do when it comes to gold and the dollar, but I am curious. You said that gold is been rallying in other currencies. Well, it doesn't, anybody who opens up a newspaper or goes on a trading site, they'll know that the dollars have been doing some rallying as well. And looking at the dollar since, let's say, July or gold and the dollar seem to be rallying together. So my question is this an anomaly? And perhaps pure speculation on my part, is this maybe them just crossing paths? Maybe the dollar is peaking and gold is bottoming, and maybe they're not going to be rallying together. Maybe they're just crossing paths right here.
Well, the great anomaly, of course, was 2001, where gold and the U.S. dollar rose simultaneously. The dollar rolled over and gold kept going. The beginning of a rip-roaring bull market that, of course, took gold from $252 an ounce to $1,900 an ounce. Is past prologue? One can only hope. I don't know the answer to that, to be honest with you, and I don't think anybody does. I think it's a topic so large with so many variables that it defies understanding. But I can hope.
Rick, I got about 5-10 minutes left. I just want to touch on two commodities. If you could just give us a brief update on your an updated thought on uranium and platinum for 2015.
Uranium I'm less attracted to. I think I was way early on uranium. The reason for that is the decline in energy prices worldwide puts less pressure, particularly on Japan, to restart reactors. You know that the shutdown of Fukushima caused a tripling of global LNG prices worldwide as Japan took every available cargo off the market. The last 6 months has seen a decline in seaborne liquefied natural gas, compressed natural gas, of 50%, and the low oil prices promise to keep liquefied natural gas prices, at least in terms of the last 5 years of markets, at low levels. The second thing that I think you need to look at with regard to the uranium price is the very low levels of aggregate demand expressed by economies that can afford to pay for stuff. The synchronous decline in soft commodities, agricultural commodities, in random lengths in the face of strong housing starts, in oil, in gas, and in copper is indicative of very weak worldwide demand, and that includes demand for electricity. So the uranium market that I had hoped to see in 2015, I think, is probably delayed until at least 2016. If we get the recovery that U.S. Major market equities appear to have priced in, then that demand picture could change. And if that happens, of course, with rising demand, a rising tide floats all ships. Mm-hmm. But until that happens, I'm afraid I was not merely early, but way early with regards to uranium. Moving on to platinum and palladium, I have almost the same observation, although the supply pattern is a lot more critical in platinum and palladium. You'll recall that platinum and palladium, the PGM metals, are produced in only 3 countries, South Africa, Zimbabwe, and Russia, each of which is particularly challenged right now. So the idea that you could have a supply disruption that was socio-political is very high on the agenda. The second thing is that it has been unprofitable to produce platinum group metals for a long time. They didn't have the boost in capitalization and the boost in supply that uranium had as a consequence of its dramatic bull market in the middle part of the last decade. The thing that's holding PGM prices back, of course, is the same thing that's actually holding uranium prices back, that is very weak demand. In this case, retail demand for autos, because platinum's primary use is as an auto catalyst, but also in terms of very weak capital investments in things like petrochemical plants and petroleum refineries, where platinum's catalytic capabilities are put to a test on a wholesale basis. So I feel better about the PGM markets than I do about the uranium markets, but I would say that they're both constrained by the same factor, which is very weak, very anemic economic growth.
You had also mentioned, I think, zinc last time I spoke to you, either in Tucson or San Antonio at a Casey Summit. Are you attracted to the zinc story right now?
Yeah, the zinc market continues to get tighter, which is attractive. I don't think that 2015 is the year that zinc prices go up, but 2015 may be the year that zinc equities increase in anticipation of a firmer zinc market the year after, because the zinc market is beginning to have some pretty extraordinary structural tightness.
Rick Rule of Sprott Asset Management. Rick, I'll make sure I have the correct website up during this interview. And what is that website that people should be directed to?
www.sprottglobal.com. Of particular attention to your viewers is Sprott's Thoughts, which is mentioned on the website. That's the best information available from the Sprott Group to your inbox 3 times a week. I guarantee your subscribers will get their money's worth because it's absolutely free.
It is. I always am excited, and I got to say that I'm a little more excited when I see it's something that you had done and these interviews you've been doing with, is it Tekoa?
Both Tekoa da Silva and Henry Bonner.
Yeah, so it's been great. I'm glad you guys are doing those regularly now. All right, Rick. Well, thank you so much, and hopefully I'll see you at a conference pretty soon.
Thanks, Dan. It's always a pleasure.
You have a good day.